The Intelligent Investor is a book written by Benjamin Graham and first published in 1949. It is considered a classic text on value investing and is widely regarded as one of the best books on investing ever written. The book presents the idea of value investing, which is a strategy that involves buying stocks or other securities that are undervalued by the market and holding them for the long term. The book also covers topics such as risk management, portfolio diversification, and the psychology of investing. It is aimed at both novice and experienced investors and is still widely read and referenced today. The Intelligent Investor Summary. The Intelligent Investor is a book about value investing, where the author, Benjamin Graham, advocates for a strategy of buying stocks or other securities that are undervalued by the market and holding them for the long term. The book covers a variety of topics related to investing, including A-sense the difference between investing and speculation, A-sense the importance of having a long-term investment plan, A-sense the concept of margin of safety when investing, which means buying securities at a significant discount to their intrinsic value, A-sense the importance of diversifying a portfolio to reduce risk, A-sense the psychological challenges of investing, such as the tendency to follow the crowd and make impulsive decisions based on emotions. The book encourages investors to take a rational and disciplined approach to investing, and to focus on the fundamentals of a company rather than trying to time the market or follow the latest investment trends. It also stresses the importance of being patient and not giving in to the temptation to sell in a downturn. Overall, the book is considered a classic text on value investing and is widely regarded as one of the best books on investing ever written. The difference between investing and speculation. The difference between investing and speculation can be summarized as follows. Investing is the process of allocating resources, usually money, with the expectation of generating an income or profit. Investors typically focus on the fundamentals of a company or asset, such as its earnings, revenue, and management quality, to determine its intrinsic value and make decisions about whether to buy or sell. Investing is typically a long-term strategy, with the goal of building wealth over time. Speculation, on the other hand, is the process of buying or selling assets with the expectation of making a quick profit based on market fluctuations or predictions of future events. Speculators are less focused on the fundamentals of a company or asset and more focused on market trends, rumors, and other short-term factors. Speculation is typically a short-term strategy, with the goal of making a quick profit rather than building wealth over time. In general, investing is considered a safer and more stable strategy than speculation, as it is based on fundamentals and long-term prospects, while speculation is considered riskier and more volatile, as it is based on short-term market movements and predictions. The importance of having a long-term investment plan. Having a long-term investment plan is important because it helps to align investment decisions with long-term financial goals, rather than short-term market fluctuations. A long-term investment plan helps an investor to 1. Establish clear financial goals. A long-term investment plan provides a roadmap for achieving financial goals such as retirement, buying a house, or funding a child's education. 2. Avoid impulsive decisions. By having a long-term investment plan, an investor can avoid making impulsive decisions based on short-term market fluctuations or emotions. 3. Benefit from compounding. A long-term investment plan allows an investor to take advantage of the power of compounding, where the returns on an investment are reinvested to generate even more returns over time. 4. Diversify investments. A long-term investment plan enables an investor to diversify their portfolio across different asset classes, such as stocks, bonds, and real estate, in order to spread risk and maximize returns. 5. Monitor and adjust the plan. A long-term investment plan should be reviewed regularly to ensure that it remains aligned with the investor's goals and that any necessary adjustments are made. In summary, having a long-term investment plan helps an investor to stay focused on their goals, to avoid impulsive decisions, and to benefit from the power of compounding over time. The concept of margin of safety when investing. which means buying securities at a significant discount to their intrinsic value. The concept of margin of safety when investing refers to the idea of buying securities at a price that is significantly below their intrinsic value. Intrinsic value is the inherent or true value of a security, calculated based on factors such as the company's earnings, revenue, and growth prospects. By buying a security at a significant discount to its intrinsic value, an investor is creating a margin of safety that allows them to withstand market fluctuations and unexpected events. The margin of safety is used as a risk management tool. It ensures that an investor is protected against any potential negative events or developments that may occur in the future. By buying a security at a significant discount, the investor is able to weather any short-term market fluctuations or negative news and still realize a profit in the long term. The margin of safety can also be used as a way to identify undervalued securities. By comparing a security's intrinsic value to its current market price, an investor can determine whether the security is undervalued and therefore represents a good investment opportunity. In summary, the concept of margin of safety when investing means buying securities at a significant discount to their intrinsic value, which is considered as a risk management tool to weather any short-term market fluctuations or negative news and still realize a profit in the long term, and also as a way to identify undervalued securities. The importance of diversifying a portfolio to reduce risk. Diversifying a portfolio means spreading investments across different asset classes, sectors, and geographies in order to spread risk and maximize returns. Diversification is important because it helps to reduce the overall risk of a portfolio by spreading investments across different types of assets, rather than putting all of the eggs in one basket. There are several reasons why diversification is important for reducing risk. 1. Reduces the impact of a single investment. By spreading investments across different types of assets, an investor can reduce the impact of a single investment on their overall portfolio. For example, if one stock or bond in the portfolio performs poorly, the overall portfolio will not be as affected if the investor has other investments in different sectors. 2. Hedges against market fluctuations. Diversifying a portfolio allows an investor to hedge against market fluctuations by investing in different types of assets that may perform differently in different market conditions. 3. Mitigates the impact of unsystematic risk. Unsystematic risk refers to the risk that is specific to a particular company or sector. By diversifying a portfolio, an investor can mitigate the impact of unsystematic risk by spreading investments across different sectors and companies. 4. Achieves optimal risk-reward balance. Diversification allows an investor to achieve an optimal balance between risk and return by spreading investments across different types of assets with varying levels of risk and return. In summary, diversifying a portfolio is important because it helps to reduce the overall risk of a portfolio by spreading investments across different types of assets, sectors, and geographies. This helps to reduce the impact of a single investment, hedge against market fluctuations, mitigate the impact of unsystematic risk and achieve an optimal risk-reward balance. The psychological challenges of investing, such as the tendency to follow the crowd and make impulsive decisions based on emotions. The psychological challenges of investing refer to the emotional and cognitive biases that can influence an investor's decision-making and lead to poor investment outcomes. Some of the most common psychological challenges of investing include: 1. Herd mentality. The tendency to follow the crowd and make investment decisions based on what others are doing, rather than on fundamentals and research. 2. Anchoring bias. The tendency to rely too heavily on the first piece of information encountered when making investment decisions. 3. Overconfidence. The belief that one's own judgment is superior to that of others, leading to excessive risk-taking and poor decision-making. 4. Confirmation bias. The tendency to seek out information that confirms one's own beliefs and ignore information that contradicts them. 5. Loss aversion. The tendency to avoid taking losses and hold on to losing investments for too long. 6. Emotion-based decisions. Making decisions based on emotions such as fear or greed, rather than rational analysis. These biases can lead to poor investment decisions, such as buying high and selling low, chasing hot investments, and not diversifying a portfolio. To overcome these biases, investors can follow a disciplined investment strategy, such as value investing, and use tools such as mental stop losses and regular portfolio reviews to help make decisions based on rational analysis rather than emotions. In summary, the psychological challenges of investing refer to the emotional and cognitive biases that can influence an investor's decision-making and lead to poor investment outcomes. These biases include herd mentality, anchoring bias, overconfidence, confirmation bias, loss aversion,